And now on to tonight's alternative investments panel. I want to introduce our moderator for the panel this evening, Charlie Waterman. He is Executive Director of Due Diligence at FS Investments, and he's also on our Society Programs Committee. He specializes in due diligence of alternative investments, and I can't think of a better person to be the moderator for tonight's panel discussion. And we're looking forward to hearing from our 4 panelists, and Charlie will introduce each of them. So I'll turn it over to Charlie.
Thank you, George. Really appreciate everyone being here tonight. I think it's been a while since CFA Atlanta has had an event focused on alternatives. So I'm really excited to bring this topic to you all, and hopefully you find it interesting and informative. As George mentioned, I'm with a firm called FS Investments. We're an alternative asset manager based in Philadelphia. I'll leave it to Mike, one of my colleagues, to tell you a little bit more about FS. Also, as George mentioned, I oversee the due diligence team at FS. So we are the team that completes the due diligence questionnaires, RFPs, and RFIs with respect to our investment funds, and I also help out on our product development team as well. So I'm going to start actually by letting the panelists, because they know themselves the best, give probably a 30 to 60 second overview of themselves, their firm, and their bio and their experience, so you know who is talking to you today. So I'll start with that. Scott, why don't you kick things off?
Okay, thank you. So I'm Scott Metrick. I'm a principal at AQR Capital. For those of you who don't know AQR Capital, we are a quantitative investment firm. And you hear quantitative, and I'm sure a lot of people are thinking kind of black box strategies. We pride ourselves on being not that. Right? That all of our strategies are based in economic theory. All of our strategies are based in fundamentals. The firm was founded a little bit more than 20 years ago. And today we manage about $185 billion roughly across multiple products, multiple strategies, including both traditional and alternative investment strategies. So I myself am a portfolio manager on what we refer to as our alternative risk premia product, and perhaps we'll get into that topic a little bit in this discussion. But I've been at AQR for 8 years, but I've had more than 30 years in the alternatives and hedge fund industry. So back in 1988, I started working in hedge funds, and over that time I've had roles both as an allocator as well as, like at AQR, a kind of more direct asset management provider of alternative solutions.
Hello, I'm Spencer Boggess. I'm head of alternatives for what is now called Truist Wealth. It's the successor firm to SunTrust and GenSpring, for those of you in Atlanta, and also the BB&T organization that was consummated in December. So we are a full-service wealth management firm, and I think it's fair to say that we have a breadth of investment activities that I think derive most directly from our roots as a multi-family office, and I think that gives substance and texture to both the character and the focus of our investment. So a lot of it is directed and informed by a view on tax, the potential tax efficiency of those investments. Prior to joining this firm, a little over 3 years ago, I was formerly CIO of alternatives at Merrill Lynch, and prior to that is predecessor firms at Bank of America, similar roles at Bank of America, U.S. Trust, and I began investing a little bit later than Scott as an allocator at Winston Partners in the mid-90s. So graying but not fully gray, really. Sort of seasoned but not too scar-tissued, really. So I'll leave it at that and pass it on to you.
Thanks, Spencer. It's kind of like the Golden Globes, but I will not go Ricky Gervais on anybody here. So, my name is Thayer Gallison, and I'm the Vice President and Due Diligence Officer for Ladenburg Thalmann Financial Services. We're the 6th oldest member of the New York Stock Exchange, but will be delisted in the next month or so as we complete a merger with another firm. Run the due diligence team and product research for the network, and really don't have much more to say on that. I do want to take 1 second, though, to say quickly, started working with Charlie in May of 2011. And I didn't know, I'd always thought about getting my charter, and I didn't really understand at the time how difficult it was. And Charlie took level 2 about 3 weeks after we first met. And Charlie was instrumental in getting me to actually go through and do the course and through the program and to get my charter. So Charlie, in front of everyone, I just want to say thanks. If you're out there and you have your charter, hopefully you had a mentor or someone who encouraged you to do it. And if you don't, then I suggest you find one because it helps a lot. Thanks, Charlie.
Thank you, Thayer.
All right, well, good evening, everyone. My name is Mike Zinkan. I'm an executive director and portfolio specialist with FS Investments, so I'm not going to be quite as nice as Thayer was regarding Charlie, but I am also a colleague of Charlie. As a portfolio specialist, get to work a lot with his team with regard to the RFPs and RFIs and helping them with that process. Just to provide a little bit of background on FS Investments, so we are a $23 billion alternative asset manager. We are headquartered in Philadelphia, founded in 2007, so roughly 12, 13 years old. We have really a variety of different alternative strategies. It's probably a good sign. I already broke the mic.
Don't drop it.
I don't know if that's a red flag. But in all seriousness, a variety of different alternative strategies, institutional partners, and then also alternative structures. Really everything we do is alternative focused, so really happy to be here this evening. With regards to myself and what my role with the organization is, I've been with FS for 5 years, and really my primary role is to serve as a liaison to portfolio management with regards to everything about the strategies we offer. So a big focus at FS is education, and so really excited to be here tonight and to talk further about our offerings and just broadly about alternatives. So thank you.
Thank you, everyone. So hopefully you can see we tried to create a diverse set of panelists, bringing different perspectives, either from the asset manager side with Scott and Mike, from what I'll call the allocator side with Spencer, and then the researcher due diligence side with Thayer. So hopefully those varying perspectives will be enlightening for you. As we go through these questions, I would say please feel free to raise your hand and ask questions yourself. This is definitely meant to be interactive and hopefully to help you all get the most out of this conversation. I do plan to start with some very high-level questions about alternatives in general, and then dive into various specific alternative strategies, and then talk a little bit about product structure, and hopefully finish with some concluding questions. I'm thinking this will take roughly 45, maybe 60 minutes, depending on how things are going and how engaged you all are. So with that, I'll start off with the first question. So last year, BlackRock published a report that looked at 14,000 model portfolios on their Aladdin platform for the year ending June 30. They found that 76% of 470 advisors who had used alts in the past 12 months said they employed alts to reduce risk in their portfolio, but almost half of the alt models they used had a high correlation to stock market returns, which essentially amplified their stock market exposure, even as some may have reduced overall portfolio risk. So Spencer, I'll start with you. Describe the role of alternatives in a portfolio today from your perspective. Should they reduce risk? Should they be a diversifier? Should they increase returns, or all of the above? How should investors think about alternatives compared to the rest of their portfolio? And perhaps, Scott, you can tack on to whatever Spencer says.
Sure. So, Charlie, I think they really want to keep in mind that the primary purpose, as I would best understand it, is enhanced diversification, largely to help diversify, for simplicity's sake, a stock bond cash portfolio by delivering returns that can hopefully over a full investment cycle show increased consistency, performance resilience on the one hand, and then secondarily help limit downside risk. The second role is really to provide differentiated beta to the portfolio. That could be simply through concentration, out of benchmark holdings, illiquidity risk or longer duration investment opportunities, but principally to anchor the portfolio in opportunities that perhaps can't be replicated easily through more liquid and more efficiently obtained exposures. Keep it simple.
Yeah, I'll echo a little bit of what Spencer mentioned here, but also I'd like to take on the beta that is found in a lot of alternative products. The name alternative, it should mean that these strategies are uncorrelated to more traditional markets. That's what alternative is supposed to mean, alternative to stocks, alternative to bonds. And they're meant to be a tool to help investors diversify away from the concentrated risks that they have in their portfolios. And they can be used as this tool to increase risk. They could be used to decrease risk. They could be used to increase the risk-adjusted returns. There's a lot of different ways that investors can use it. But I think the reason why you find that many alternatives have a lot of beta in them is because there are business, institutional, even career risks associated with differing from peers, differing from equity markets. And nobody likes to explain why their portfolio didn't do as well as the market did last year. It's great in theory to have uncorrelated strategies, but when they underperform, it can be difficult. And I think for that reason, as well as some others, you do tend to find a lot of products that have a lot of correlation to equity markets. And I think as investors, you've got to pay very close attention to this. And it's easy for me to say here, in theory, one should always strive to have as uncorrelated a strategy as possible. But in the real world, that may be a little less practical. And we actually offer both market neutral strategies, uncorrelated strategies, as well as what we refer to as total return strategies, which are alternative in that they are long short, they use leverage, derivatives, and are not completely correlated to markets, but they have a modest level of correlation.
They asked me to get close to the microphone. I just wanted to further what you were saying. It's, when it comes to a retail investor, the idea that an alternative investment is going to diversify your portfolio sounds great. The ability to live through it is quite another thing, right? I mean, we all want the magic bullet of, increased returns and less risk and diversification. And I think it really is important to educate clients that, that outperformance is going to come through that full cycle, like you mentioned, Spencer, and is going to reflect in not outperformance during the years where the S&P 500 is up 25%, but rather through the full cycle where there's been negative markets and you end up outperforming a blended portfolio or benchmark.
Yeah, and you touched on it. One of the things we think about is the cost of diversification, right? We always say that diversification is the only free lunch, but it's not, because in a year that the stock market's going to go up 25%, this won't. What do you guys think? Like, what should we tack on as like an expected return for a bucket of all? So, is it inflation related? Is it absolute return? Is it correlated with the markets? What do you guys try to focus on when you think about expected return for these investments?
I'd be happy to take it.
You haven't gone yet.
I guess I got to go first. That's a great question. I think the biggest challenge with alternatives in general is having appropriate expectations and maybe from our side setting appropriate expectations. I think the challenge with alternatives is it's a huge bucket. It's everything from private real estate to managed futures. My expectations for those are drastically different. So I think it has to be more specific to the particular sleeve or strategy you're looking at. And one of the things that I really like to talk about, and this is more at the retail investor level, is stealing something that Wellington used to talk about a lot when I worked at Hartford, and we did a lot of business with them, and it was think, function, not form. It's really what is that strategy or that allocation trying to solve for in a portfolio, rather than saying 5, 7, 8, 10%. Certainly some strategies you need to have a specific return expectation in the alternative bucket, but I think another lens to look at it as is, well, this is a growth strategy, this is an income strategy, this is diversification, this is whatever particular problem or outcome you're trying to solve for. I think that lens can be helpful in setting expectation and then importantly evaluating a strategy after you've allocated to it.
Yeah, I would say I would agree with the fact that there's a wide variety of alternatives. So there's not one return or risk number that you can plug in. I think what a good exercise would be to take a Black Litterman type model and plug in a return and a correlation and a standard deviation for a set of alternatives. Find what blends the best with your particular portfolios that you're doing for clients. Once you've done that, you can look for a mix of alternative investment indexes that meet that same risk, return, and correlation sort of has a match there, and then you can go looking for the managers who can best deliver those strategies.
I think we're going to move towards a more elegantly academic response in short order, but I think it's fair to say, depending on the particular strategy itself, look institutionally, what you're looking for is a LIBOR plus definition, 300 to 700 basis points based on the character of risk you're taking. In some instances, you can target a more absolute number, but you want to have it contextually to a number of things. So, for intellectual honesty purposes, I think you want to have some industry benchmarks. I think you want to have a LIBOR plus strategy, and I think you need to conceptualize it a bunch of different dimensions. I'd also, we have a lot of discussions, particularly with clients, about talking about the market environment and the risk factors in the market overall to help contextualize a little bit better what we're trying to achieve, both with pieces of the portfolio as well as specific strategies. So I think a pragmatic approach is necessary, but I think having a bunch of different dimensions to look at it and anchoring the discussions around that and then returning to that so you can help discuss how the circumstances of the current environment map to how a particular strategy may have done or not done. And I think you can talk about merits and demerits of that accordingly.
Yeah, look, I think without belaboring the point too much, alternatives is a label that covers a very broad spectrum of strategies. Some very low Sharpe ratio strategies, some very high Sharpe ratio strategies, some that run at very low levels of volatility, and some much higher. So I think it's very difficult to assign an expectation for what an alternatives portfolio delivers, because it really depends on what kind of alternative portfolio. But I also think that you need to not just think about what kind of return expectation do you get from the alternatives piece, but the idea, if it is diversifying, is more of what does this do to the risk characteristics, the return characteristics of my overall portfolio. And in many cases, what it may do is it may actually, mostly because these things tend to run at lower volatility, it may actually reduce the actual return on the portfolio level, but improve significantly the return relative to risk. And for those that are willing to do so, that actually allows you to risk up other portions of your portfolio, to take more risk, to get more return at a more reliable relationship between return and risk. That wasn't academic.
Great, thank you. So we all know in 2019, the S&P was up over 30%. The Barclays Ag was up 9%. And if you looked at a 60-40 stock bond portfolio, you got roughly 22% in returns. So I know I've certainly heard this question. Do we really need alternatives? Thayer and Mike, why don't you guys just touch on that? At this point in time in the market, based on what happened last year, do we really need alts?
Yeah, to quote Star Wars, it's a trap, right? I mean, we all know that the market's not going to go up 25% forever, and neither are we going to have years where we have the bond market up so strongly with the stock market as well. So really, as professional investors, it's really our job to not fall into that trap and to educate our customers, our clients, that alternatives are there for when you need to buy them when you don't think you need them, so that when you do need them, they are there. I see far too often, I work with a lot of financial advisors, and I see far too often people have demand for those diversifying strategies only after the event, and that's when the strongest demand comes. And so, you can talk about education. I'm not going to tell you what to say, but educating advisors and then so they can educate their clients is big there.
I think if we rewind a year ago and surveyed everyone in this room, I don't think anyone would have predicted the kind of returns we saw from U.S. stocks and bonds. I mean, it's really amazing, and hopefully everyone in this room has benefited from that. But in our opinion, people need alternatives more than ever. This might be overly simplistic, but if you just look at a typical 60-40, let's use the S&P 500 as the 60 and the Barclays Ag as the 40. What are expectations for the S&P 500 going forward? I mean, if we look at valuations, it's probably about a 5% annualized return. If you look at the Barclays Ag, the best predictor of future returns is current yield. Yield is sub 3%. So let's just call it 5% for stocks, 3% for the Barclays Ag. We can hopefully all do the math. We wouldn't be in this room if we couldn't. That works out to 4.2% expected return for a 60-40 portfolio. Our research shows from the clients we work with, our average investor expects an annualized return of 7% over the next 5 years. 4.2% is nowhere near 7. So from our perspective, traditional investments are just not going to cut it for what investors expect going forward and have become accustomed to. So we think besides the benefits of diversification and downside protection, we think alternatives have to be a part of the solution going forward to meet the expectations of investors. So our view is the argument's never been stronger than now for allocating to alternatives given the outlook for traditional stocks and bonds.
Great. So I want to spend a couple minutes talking about the most common challenges in the alternative space. And that includes lackluster performance, non-correlation, or too much correlation, as we talked about, higher fees for investors, and oftentimes these investments are just more complicated to understand. So I want to go into each of those challenges and just touch on each of those. We can go quickly if you guys want. But let's start with non-correlation or lack thereof. Scott or Mike, as the two asset manager representatives on the panel, what should investors look for when thinking about correlation to their other investments? Anything to add that we haven't already touched on?
Yeah, look, one thing I would mention is that, if, getting back to the last point, if the market's going to do 20+% every year, then you don't need something that's uncorrelated. But nobody, I think, really expects that that's what's going to occur. But what the expectation is for uncorrelated strategies, and look, what I'm about to say may end up sounding a little condescending, and I really don't mean it that way. I just can't help myself. But I think that investors view uncorrelated strategies as providing some kind of a hedge, some kind of protection to their portfolio that it really isn't. Right? An uncorrelated strategy means that when, over a short period of time, if the market's down, it's a coin flip as to whether that uncorrelated strategy is up or down. And if the market's down, there's a 50% probability that an uncorrelated strategy is going to be down as well. That's not protection. Right? Protection is a negatively correlated strategy. And I think investors want it all. Right? And they want to find strategies that are positively correlated when the market's up and negatively correlated when the market's down. But that just doesn't exist. Right? And diversification is a good thing. It makes your overall portfolio more reliable. But you also have to think about the time frame of when correlation matters to you. Right? If stocks are down 10% in the matter of days or a week, and you have no expectation, there's no link between an uncorrelated strategy's return and stocks. Right? So if the market's down 10%, it's kind of a flip of a coin as to whether that uncorrelated strategy is going to hurt you or help you in that instance. But do you really care about what happens over the course of a week? Right? Oftentimes we see the market is going up, and it's down 10%, and then shortly afterwards, in a couple of weeks, it rebounds. Is that what you're looking to protect against? No, what an uncorrelated strategy really does for your portfolio is the protection it will provide for you is when you have a protracted bear market. Right? It's a 50-50 shot in any given day or week how any strategy is going to do generally, right? But give it a year, right? Give it 18 months, and it's going to behave more like it does in the long term, and those strategies are going to have positive expected returns. And it's not protection that it's up because the market is down, but over a longer period of time, it's up because that's what it does. And I think it's really important to think of correlation and think of the time frame in which it impacts your portfolio and the time frame in which it doesn't. And a lot of uncorrelated strategies are along other kinds of risks, just different kinds of risks. And when risk aversion increases, the amount investors require to take on risk changes. So you may even have a headwind in the short term if you've got alternative strategies and risk aversion spikes in a short period of time.
Yeah, and what I'd add to that is going back to a comment that Scott made earlier about equity beta, and this is probably most specific to the liquid alternative and hedge fund space. There are a lot of strategies out there that have made a lot of money via equity beta, and I think that's one of the reasons why I hear this sort of saying all the time, which I think is justified. They didn't deliver when I wanted them to. Equity beta generally has been very much in favor since the end of the financial crisis. Having equity beta has been great. But that is also the trade-off of that is what Scott alluded to. When equity beta is out of favor, those liquid alternatives, those hedge fund strategies are very likely to also be down and not provide that diversification. So I think that's a key thing. I know I always look at is what's the equity beta relative to the S&P 500. If you want to call it what's the credit beta, things like high yield, bank loans are strategies that also a lot of alternatives have had exposure to that. We know how those assets tend to perform in risk-off environments. Correlation is an obvious thing to look at, downside capture. So those are some of the things that I sort of focus on to try to find something that's really going to be a good diversifier. And then the other thing that sort of came to mind as Scott was talking is the difference between a hedge and a diversifier is night and day. Those words are used as synonyms. A hedge is something I expect to be up when the market's down. A diversifier, as Scott said, I don't know. It might be up, it might be down. I think diversifiers have a lot more power in a portfolio. A hedge, you're making a bet that the market's going to be down. So that's a big difference too, and that's something that came to mind as Scott was talking. Huge difference in what my expectations are for a hedge versus a diversifier.
And to further that point, a hedge, something that's negatively correlated to the other things that you own, has a cost to it long term, right? If the market's up over time and you're negatively correlated to it, there are very few hedges that have positive long-term expectations. And that's why diversification is about as good as it's going to get.
More succinctly to the broader point, risk isn't standard deviation, it's capital impairment. So that's, we're trying to contemplate an approach to diversification where you can reduce your chances of permanently impairing capital, which obviously has profound impacts on people being able to read their spending needs, et cetera, over time. So, alternatives and the range of exposures available to play a key role in sort of enriching the toolkit. That started to be succinct, and then it stopped being succinct. I just wanted to be very technically
it was
accurate
perfect.
there.
Don't be so hard on yourself. It was good.
It felt good. It felt good to say that.
Yeah. All right. So let's talk about another challenge, lackluster performance. Spencer, maybe you can be a little bit more succinct this time. Which alternative strategies have had lackluster performance in your mind, and why?
So most liquid alternatives have done fairly poorly. I think the reason for it is that, with certain exceptions on this panel, it's a highly congested and poor quality space, and so it's not done very well. Just to use an example, I would tell you that long-short equity, particularly as expressed in liquid alternatives, has been particularly disappointing. A lot of firms have had fairly significant factor risk based on sort of a value-oriented long book and a short exposure to growth, and as the growth value differential in performance has been severe, that's led to unusually poor performance from a number of providers. But I think that's just the simplest point, is that liquid alternatives in broad strokes have done poorly. There are some very conspicuous exceptions, but they're far fewer than advertised.
Is there anything to add to that?
I think I'm going to challenge the premise of the question just a little bit, because I think when it comes down to it, if you can identify the strategy, it's not the strategies themselves that are underperforming, it's the managers executing the strategies many times. So the strategies will come in and out of favor, and if you can predict that, then God bless you. But really, at the end of the day, if you can find the strategies that historically through a full cycle provide the proper diversification that you're looking for, it's really all about manager selection then. I mean, as the world goes to passive investing, this space is still a very active space, and it's very important that you pick the right managers, and it's a difficult exercise. So,
Great. So let's move on to complexity. Mike, from your perspective, what can asset managers do better to make the strategy or message easier to understand?
Yeah, so to the complexity, I mean, that's probably the second most common complaint I hear about alternatives in general. First being performance, second being, these are super complex. I think those things feed on themselves, that complexity makes it harder to understand performance, in particular underperformance. I'll speak just personally how I sort of try to address the complexity is really think of things in the alternative space in one of two buckets. There's alternative assets, which are where I would put real estate, private equity, venture capital, things along those lines. And then there's alternative investment strategies. Let's call that hedge fund or hedge fund-like strategies. So I think it's helpful to sort of segment alternatives. That's still not breaking things down as far as you need to if you're going to make an allocation decision, but I think having that segmentation into those two broad buckets I think can be helpful in sort of getting past some of that complexity, because your expectations for an alternative asset are likely very different than an alternative investment strategy. And then for us, one of the things that we try to do to address that complexity is have a very specific framework in how we talk about our offerings. What's the strategy and what are the benefits it brings to an investor? What is the manager, or who is the manager, better said, and what is the structure and why do we think there are benefits to that? That complexity likely for these strategies is never going to go away. They're going to always be more complex than a long stock mutual fund. But I think having that framework of strategy, structure, manager, I think can help address some of that in making it more digestible for, in particular, individual investors.
Scott, you want to tack on to that?
Yeah, I would. When it comes to complexity, this is the face of complexity. The strategies that I'm involved with are quantitative, they're long, short, they're multi-asset, multi-strategy, they use leverage and derivatives. It is really complex, and it's not easy to succinctly describe what is going on at any point in time in a portfolio with that kind of breadth of complexities. The answer to how clients should, how you communicate such a complex strategy to clients and how clients should think about it, for us it's really a dedication to education and a dedication to transparency. It's helping investors understand what it is that they have. And we're actually quite willing to go into, to be very transparent and get into kind of the most granular levels of what we do. I suppose there's probably some limit there to where our willingness might stop, but we really are willing to. But the fact is, for most investors, knowing how the algorithm is constructed really doesn't have a lot of value to them. So I think I have this problem because I started in this field as an allocator, and I did due diligence, and I wanted to know every little detail of every strategy, and I often approach every meeting with our clients like they want to know the same thing, and a lot of them don't, and they probably shouldn't either. I think what's important is they need to know enough about the strategy to appreciate its characteristics. Right? They have to know what drives returns. What is going to cause this to do well? What is going to cause this to do poorly? What is the kind of intuition behind why the strategy should work in the first place? What kind of exposures accompany the strategy? What does the risk and return characteristics of the strategy look like? They need to know how it behaves, and we're quite willing to get into the details of any of the components, but it can be overwhelming, and maybe trying to gather every little detail is losing the forest for the trees.
And such a quandary. Sorry, it's such a quandary because you've got clients who don't truly understand where the returns are coming from, and then when the returns aren't what they want, then that makes them more likely to want to get out and to challenge their financial advisor about that. Sorry.
Go ahead.
So I'm going to start my question with like an exaggeration, that it takes 50 years of data to tell whether or not a firm is good at what they do. And so I'm wondering, when you're talking about all these things like standard deviation and correlation coefficients and all, if the pool is stable enough, is it deep enough, do we have enough history to actually make those kinds of comments, or is that part of the grain of salt that you have to look at when you're talking about allocating to different pools, as just like understanding that maybe there's still some time that we need in order to get some good standard deviations, correlations, whatever.
I think it's a very fair point. Yeah, I mean, sure, we'd love to have 50 years of data. That's why I think manager selection is so important and so difficult, because you are dealing with limited sets of information. As we look at an overall asset class, right, you've got a much longer track record that you can look at. When it comes to a manager, right, there are studies that show that the persistence, especially in private equity, of outperformance continues, and I say until it doesn't, because you're only dealing with people many times who have run, let's call it half a dozen funds, and maybe they did do well, and maybe their strategy did work, and maybe it's been arbitraged away. You just don't know, and that's what's up to you to try to figure out, is who's the manager who's going to persist and who's the manager who's not. And I don't know, maybe 50 years from now, let's check in again and we can see how that's worked out.
Okay, great. So I want to just quickly touch on the last common challenge in high fees. Spencer, from your perspective, what is the most effective way for a manager to justify higher fees?
At risk of cliche, the quality of risk-adjusted returns, I think, I would call, fair comparisons as it relates to firms' strategies that are run somewhat similarly. And, and I think net results are really a critical element here. But I don't want to stammer and say obvious things. I'd like to pass it to my colleagues or peers.
To stammer and say obvious things?
Yeah.
You guys have low fees, right?
Yeah, I'll have a shot at stammering and saying obvious things. Look, I think that one should think of fees relative to what one is getting. I mean, that's obvious. You should think about the fees that you're paying relative to the active risk that you receive. If you're getting a lot of beta in an alternative strategy, you can get that for free. You don't need to pay for beta. So you should be taking a look at how much active risk, and this also becomes a cash efficiency thing. Right? If you're getting a lot of active risk, that has impact on your portfolio. You should want a more volatile strategy if it's uncorrelated to other things, and you should be willing to pay for higher levels of volatility because it is more impactful to your portfolio. And here, of course, I'm assuming it has a positive impact on that portfolio. So you should think about how much active risk do I get? So what is my fee per unit of active risk? But there's another aspect to it as well, and this is my day job, right? The idea of an alternative risk premia really gets to what kind of strategies are unique and which kind of strategies are not. So if you are gaining access to a unique strategy, something that you really can't get elsewhere, well, then the manager is justified in having a higher fee. It's a unique return source that you can't get anywhere else. But how many unique return sources are really out there? I mean, when you scour the universe of alternatives, you find that there are a lot of very common, very well-known things that managers do. That doesn't mean they don't have value, right? A lot of very common, well-known things act like alpha, right? That they can really diversify your portfolio. They can provide you with attractive risk-adjusting returns going forward. But why pay a high fee for something that you can get in many other places? So if a strategy is more commoditized, and it doesn't mean it's a bad strategy, right? But you shouldn't pay a high fee for it. If a strategy is not giving you a lot of active risk, you shouldn't pay a high fee for it.
If strategy is becoming commoditized, you should be mindful of that and scrutinize the character and the quality of the returns.
Go ahead, Chuck.
Quick question for you, Scott. You opened yourself up there. There are some strategies at AQR that are available through different vehicles, both the traditional partnership and some very similar ones that are the liquid mutual fund version. Are you finding that some of your partnership folks are saying, hey, maybe we need to look at fees in the partnership because maybe I could just go and take advantage of this on the liquid side?
Yeah, look, we got into the what investors call liquid alternatives. We started as a liquid alternative manager. We didn't offer mutual funds at the time. We were involved in strategies that were liquid. But we got into the mutual fund business, which is what a lot of people call liquid alternatives, when you do an alternative strategy in a mutual fund, much earlier than many. But we had kind of built a reputation on much of what I just said, right? Calling out, where one should get compensated and where one is adding less value, and pricing appropriately. And I think there's been a lot of fee pressure in the industry overall. And I think we, to some degree, I don't want to take total credit for this, but I think we were a catalyst to that. And when we thought about how we're providing our strategies, it was not about what should we charge for a vehicle. We had a strategy that you could employ in an offshore fund, you could employ it in a U.S. mutual fund, in a European UCITS vehicle, separate account, you name it, you could do the same thing because it is liquid across many different vehicles. And what we did, which differed, I think, from many, is we priced it to be what we thought to be equivalent in the mutual fund relative to the offshore funds. Now, there are some wrinkles to this, right? In the offshore fund, you can have a structure that includes both a management fee and a performance fee. You can't have a performance fee in mutual fund, so you price them equivalently, assuming you hit the rate of return that you think that you're going to get. And that made us really indifferent as to whether we raised assets in the mutual fund or raised assets in the offshore fund. And to some degree, I think the investors didn't care which vehicle they were in. We did find that mutual fund investors have a little less tolerance for volatility, so we offered it at a lower volatility level, but scaled the fee appropriately. I find that in the liquid alts world, not all managers are doing that. In fact, they are very afraid of cannibalizing higher fee business, so they offer products that are really just a shadow of what the offshore vehicle may be, right? Because they can then tell their hedge fund investors that, no, you've got the Cadillac here, and that's just the Ford. No aspersions on auto manufacturers here. But we never took that approach because we were priced pretty low to start with, and that pricing did work well in the mutual fund environment.
I would say another challenge of alternatives is especially for taxable investors, is the after-tax return. What innovations have you guys seen or done in this space to make a higher after-tax return for those investors?
I'll start by saying you should talk to the guy that's to your left too. We've had a very big push recently for more tax-efficient portfolios and strategies that are very tax conscious and actually can even produce tax losses while performing positively. Traditionally, the taxable world has been something that hedge fund management firms have forgotten about. That they trade very frequently, they're very inefficient from a tax perspective, and most are great for the pension plan or the tax exempt investor, but returns don't look so good on an after-tax basis. It doesn't have to be that way. There are structures that some use, but there's also just strategies that can be employed to embed after-tax returns.
There are certain strategies for a while. First of all, the tax dimension of this are hugely important. the way we think about taxable portfolios and the strategies we'll use and how we'll use them are very different from an after-tax basis. Put differently, or conversely, there are certain types of multi-strategy managers that may have made sense sort of perhaps the pre-Obama tax regime, but I would tell you that in certain states like New York or California, a 3% management fee on a high turnover strategy makes them largely uneconomic. So we have a very significant emphasis on trying to figure out ways in the taxable book to perhaps take more credit beta and more equity beta risk in an effort to be more tax inefficient, and try whenever possible to use the less efficient strategies outside of it, as Scott evoked quite well. But not enough people look closely at that, nor have they seen how terrible the tax consequences have been for certain types of strategies over the last several years. Some of these tax changes have come to the fore, and certain high tax states have gotten even more brutally nosebleed as it relates to the consequences for risk assets. I'll stop there, but thank you for bringing that up.
Yeah, that's a good question.
Yeah, maybe the only thing I'd add is, I mean, it's a huge challenge and a huge opportunity. I know we're spending as a firm a lot of time sort of researching and looking into it. I wish I said I had an answer for you today. But I think the big struggle for us has been, what are the trade-offs for that? Obviously, your perspective is coming at it from the other side of the table with what are the tax consequences. Ours as well, if you adjust X to do Y, what are the consequences? So it's a fair question. It's something I know we're working and thinking a lot about. And there's a huge opportunity there and a huge need, frankly, to address that.
It has to evolve. It has to evolve because the typical customer for these types of strategies and these types of managers in the past have been tax-exempt entities, right? Endowments, foundations, pensions, you don't have to worry about this. So it'll have to evolve.
Scott brings up a compelling point in that a long time ago, managers could short against the box or a range of things that they could do to help sort of offset some of the tax consequences, just use long short equity. That sort of dates me, the fact I'm even referencing these strategies. But there are a lot of strategies as a function of pure equity long short managers, as a function of running the bulk of their liquid net worth in the strategy, have a very strong vested interest in managing the tax bill. And what they typically do on the most mechanical basis, after sometime in the first quarter, they take tax lots and they're selling on the margin using the information from their CFO or controller to help sort of manage the tax consequences of the strategy. Some people are very focused on that. Some of their strategies, maybe as a function of being longer biased, is more, how shall I say, congenial to that type of approach. We're certainly mindful of managers who that's in their DNA, that doesn't determine ultimately decisively that we're going to invest with them or prioritize them, but we're certainly mindful of what strategies are considerably more tax efficient. And there are some clients, and because of the disposition of their assets, who care deeply about being invested in those types of managers and manage risk differently in the broader portfolio construct. And we've seen insurance products also come roaring back as a function of a lot of the negative tax consequences of this. So we've seen a lot of retired hedge fund managers, et cetera, make sure that they can defer a lot of their assets by placing them in a variety of insurance. I'm not encouraging that. I'm just simply saying that explains these tax dynamics and also explains the proliferation of people offering that advice.
Another question back there.
Yeah, so let's see if you can hear. So, all right, there we go. So the alternative investment space is really broad. So my question would be, what segments of the alternative investment space would you have high conviction on based on the environment that we're in and moving forward, and what segments do you think might struggle?
You took the questions right out of my mouth. Perfect. Who wants to start?
I'll take it. And I'm going to start with a cop-out.
We all are.
I think that it's very hard to time alternative strategies. And it's also very hard to describe the environment in which they do well or poorly. And the reason for that is simply what we're accustomed to. right? We're accustomed to thinking about the environment in which traditional investments do well or poorly. So we describe environments as ones in which you've got interest rates going up, you've got inflation, you've got growth, corporate earnings are up or down. These things directly impact stocks and bonds. But if you're building uncorrelated strategies, those things are going to have no influence on these strategies. The various strategies, the risks that they're exposed to, the things that are going to cause them to go up or down, are much more idiosyncratic. And they're also very hard to time as a result. When you're involved in one of the things that's been a pain in my side lately is what's been going on with value, going long cheap companies and short expensive companies. I can tell you exactly when that started to be a problem for us. Even with 20/20 hindsight, I struggle to tell you why. What caused that to occur? Well, the easy answer is that it was investor preference. Investors just started to show preference for growth companies over value companies. And we know that happens from time to time. That doesn't mean the strategy is broken. But what causes investors to do that? It's really difficult to say. Now, that's not true of every alternative strategy. There are things like if you're looking at event-driven strategies, right? You can look at deal spreads, and you can look at deal volumes and the number of deals. And in convertible arbitrage, you can take a look at how cheap or expensive the bonds are relative to how the options embedded in them should be priced. There are certain strategies that you can tell that now may not be a good time for converts because they're trading pretty rich, or now may be a great time for merger arbitrage because the spreads are wider than the risk should dictate they be. But most alternative strategies aren't nearly as clean in that way, where it's easy to vocalize in a manner in which we're accustomed to hearing the things that are pressuring or the opportunities that they present. Now, with that said, we have tilted our portfolios a little bit to value because value has done particularly poorly. And if you look at the valuation ratio between the things that were long and the things that were short, it's really extended. But I still don't think we can necessarily get the timing right. It's just that the attractiveness level warrants maybe it getting worse before it gets better, more so than if those spreads were more normal. So even when we're taking a bet, I can't really say that I can articulate a reason why it should move in our direction other than to say that it's attractively priced.
Yeah, just to pile on that and to get back to sort of segmenting alternatives into alternative investments and alternative investment strategies, I think it's always hard to time alternatives, but I think there are things you can look at, and you alluded to some of them, Scott, for alternative assets, real estate. I think we all know real estate has had a tremendous run. Do you want to be a lender or do you want to be an owner? That's your decision to make, but there are specific things you can look at there. Private equity, we see the headlines every day about the amount of dry powder. There are things you can look at there. I think it's a much easier, I don't want to say it's easy, but it is easier to make that decision on the alternative assets. Alternative investment strategies, as Scott said, those things are totally different animals. It's much harder to look at factors to make that determination or valuations to make that determination. I think some of the things that Scott alluded to, maybe those bets or things that are being expressed in the portfolio are the things you have to look at on an alternative investment strategy or a hedge fund to get a sense of what the return opportunity is on an absolute basis.
I'll be a little bit more direct and just simply say that our sort of bias against mega buyout funds has sort of hardened, if not strengthened, if you will. EBITDA multiples have climbed. You're seeing more club deals. You're seeing more sort of private equity exit on usually the telltale signs historically of that space being overheated is you see both the shorter time frames for fundraising between funds and sharper increases proportionately between the size of one fund and the next fund. And when those are going up, that tends to point to a market that's overheated. And if you will, just in terms of the appetites for them. So I think we have always had a certain caution because that segment's a little more dependent on financial engineering than I'd say lends itself to what I would call, consistent and skillful value creation at the company level. I think another area of potential concern is the private credit space, where there's just been indiscriminate selling of that as a yield product, particularly in the retail space. Not all of it is well underwritten. Yields have come down. If you talk to companies, people are throwing money at them. The anecdotal evidence is not compelling. So I think those are areas that I think there's more risk, certainly, and potential for impairment. I think mega buyouts, I think it's sort of a cyclical thing, but I'll just leave it there.
So I'm hoping one of you can talk to private real estate relative to public real estate. And it just occurs to me that if you line up the two and you go the private route, you've got higher fees, you've got potentially less transparent accounting, it's illiquid, and you basically have the same assets. And so why do folks go the private route? If you can talk to that at all. And it seems to me that also that the answer is often that there's lower vol, and that's just because of the liquidity issue, which doesn't make a lot of sense to me. But I'd be interested in your thoughts.
Yeah, so the volatility is one thing. The biggest for me is the correlation. The correlation for a traded REIT is going to be 0.8 or higher. And if you think back to sort of where we started, why are you allocating to alternatives? One of those major things is diversification and lowly correlated returns. You give that up when you're buying traded REITs. I don't have anything against traded REITs, but what that brings to a portfolio is totally different than a non-traded REIT, whether that's on the equity or the debt side. So, that's the biggest argument in my eyes. And I think, I'm cautiously optimistic on U.S. equities personally, for whatever that's worth. So I'm not negative on equities, but I do think, the implications for volatility much more powerful if you go with something that's private.
Well, is the issue there just one has a mark and the other doesn't?
It's appraisals and the frequency of them and the smoothing effect that has, absolutely. I always find it a bit disingenuous when a manager tries to sort of offer a strategy and saying that it's very low standard deviation when the reality is it's got plenty of standard deviation, you just don't see it.
But would the argument to counter that would be, what is the client's experience actually going to be?
No, right, and their ability to stick through it as a result of that.
Yeah. So, I mean, it's a fair point. When the tide goes out, everyone's going to see. But I think, the client experience, particularly having a huge focus on individual and retail investors, I do think that experience is going to be different with a traded, even though they are holding, with a non-traded than a traded, even though they are holding the same asset underneath.
Yeah, and I don't want to make it sound like having a private real estate is that you don't have lower volatility, because the honest truth is the public real estate funds are adding a premium and a discount to those NAVs. I mean, the REITs are all, public REITs, they're all calculating their NAVs, and they probably disclose them in their 10Ks and 10Qs to a large degree, and the market is assigning a premium or discount to that. You remove that completely, you've already got something that's less volatile.
So I want to ask a question as it relates to the ESG. Are you seeing a lot of demand as it relates to the ESG, or is that driving any impact at all?
Spencer, any thoughts on that?
Environment, social, and governance.
We're seeing an enormous amount of interest. I think interest and level of commitment sort of skews geographically. I think from our families on the West Coast, et cetera, this is just sort of expected. You're supposed to be able to invest portfolios, informed, with high quality ESG managers, to identify compelling opportunities from an impact investment perspective. These are expected in terms of firms offering private wealth space. I think the more interesting thing is how much that sensibility is affecting the whole sort of financial services ecosystem. I mean, Larry Fink's letter from I think last week is quite notable, aside from the fact that it looks like he wants to be Treasury Secretary. he's highlighting something about the fact that these types of topics are being aggressively debated on college campuses. We get requests all the time for carbon neutral strategies. I'll tell you that there's a lot more interest in discussing it than investing. But I think that that's changing quickly. And I think as you find individuals below the age of, say, 35, this is front of center, front of thought. And again, geographically, a lot of our families, and again, I'm just pointing out on the West Coast, this is, they've not just contemplated this, they're conceptualizing their wealth investment, their wealth strategies entirely based on those types of concepts. So it's a bit of an elliptical answer, but I would tell you that also that, large pools of assets are beginning to identify that portions of their index assets they want to be invested with pools which meet some minimal criteria in terms of ESG scores. And so I think it's beginning to impact not just index companies that conceptualize indexing, but financial reporting more generally. And I think that's where you're going to see the future go, is that this much more elaborate architecture in evaluating the character of financial performance according to these attributes. And you'll see a lot more large institutions or identifying portions of their assets being committed with these attributes being built in, and this being defined in an IPS statement, et cetera. So again, I think it's a sea change, but you have to look in the right places. There's a lot of bad product also chasing this, but there are a lot of first-rate asset managers doing work in the space as well. The potential for greenwashing is material, but I think that's where research comes in.
I'm really glad you brought up impact investing, because I look at that as a corollary to ESG, and I was very surprised when we looked at an impact investing fund at what our ultimate demand was, especially since in our analysis we estimated that people are losing about 100 basis points in yield per year for the same amount of risk in order to invest in debt into companies in third world countries. So this fund would invest in a diaper manufacturer in Peru, or companies in Central Asia or Africa, right? So it was making loans, first trade finance and then making loans to these companies. It was something that from a demand perspective we had heard that people were asking for. When we actually brought it out with those characteristics, I was surprised at how well it was adopted, and it was adopted very well on the coast and amongst young people. Like you said, I think 35 and younger. We don't have a lot of clients in that age range, but that was a typical client for that.
It's the second gen folks that are asking for it materially. They may not have the full claim on a wealthy family's assets, but they are adamant that their smaller pools are allocated in a way that aligns with their values. And we're spending a lot of time from an education perspective engaging with people like that, helping them understand how they can do that thoughtfully.
And I want to bring the G in ESG quickly to the front, because that's something that we're seeing in alternative investments is something that's it's been very important to us and will continue to be, is improving the governance of these programs. So if you've got a limited partnership or the general partner has complete control, you've ceded a lot to that person. We would demand in that circumstance that they have at least some way for shareholders or partners to remove that manager for cause or for other reasons. And in some of the publicly registered products where they are required to have independent boards, that person may not look like they have a relationship with the company when they get nominated to the board and get appointed, but you find out later sometimes they do, and so maybe a third party selecting those people would be the most appropriate. So in terms of governance, it's for alternative investments, it's something I think you're going to see a lot more attention paid to in the coming years.
Yeah, so if I could chime in. So we have a very global business, and the demands that we're seeing in the U.S. as it relates to ESG are many steps behind what we're seeing in other places. You can't do business in Denmark or Sweden or Norway, without having ESG product. Our UK clients, there's regulations being passed that pension plans need to be conscious of what their impact is. And what you find is that this is an area that's really in its very nascent stages. We talk about it as if it means something, and there's so little defined at this point, right? That in the U.S., ESG is generally, I don't want to do tobacco stocks, no cluster munitions, or no carbon. But even then, you get into the conversations of, okay, in a long-short portfolio, is it we can't do it, or can we short them, or is it okay if we're, net short, but we can go long some and go short more of others? And there's no definition. And what many people offer in terms of ESG products, ourselves included, are based on ESG scores that come from Morgan Stanley or come from another provider. There's really only 2 providers out there. And there's wildly different scores that you get on companies, between these 2 providers. And if you went and did it yourself, you would find that you would come up with something completely different. So how we think about this, how we actually execute, portfolio strategies with noble intent, is thorny. And it's really easy, this greenwashing thing, it's really easy to say that, we do it. But it's got to permeate every manner of what you do. It's not just being long a bunch of companies that score better than the ones that you're short. It's got to come into the analysis process. It's got to be who you are, even. I mean, we've gotten rid of paper cups in the office for this very reason. I mean, it's really got to permeate who you are. But what we find is the more and more we try and do in the area, the more we find we don't know. And there's nothing that's uniform in this area. When it comes to the G of ESG, we actually think we've been doing it for a long time, we think there are profitable strategies, right, that you can dedicate around governance. When it comes to the E and S, it's a little less clear, and there's debate in the organization, about long-term and theoretical, whether companies that are more favorable from an ESG perspective should outperform another. But you could also be giving up return, but that's okay. I mean, if this is the choice that you make, that this is important to you, and if it means giving up some return, then so be it. But at least one of the 3 letters we think can be profitable. Maybe the other 2, but that's not clear yet.
I think this gentleman.
I have a quick question for you, and with that very short response that you gave, you almost answered my question. So I wanted to find out, with this build out taking place in the ESG space right now, and it's in its very early stages, are we going to experience what we're experiencing within the hedge fund space, where there's a huge disparity based on manager selection? Because it seems to be a very complex space as far as its implementation is concerned.
Just to clarify, you're saying, will there be a huge disparity in terms of the
performance,
winners and the losers?
Well, yes, exactly. The performance of these funds. Everybody is slapping that ESG moniker or label on this, and as you know, how it's delivered, how it's implemented is a little bit different as far as screenings and things of that nature, and just the complexity of the different types of strategies that may underlie that ESG framework, if you will.
Yeah.
You start to see that emergence of, okay, it's all about the manager that you selected rather than something else.
Well, look, the ESG integrity is in the eye of the beholder, and a little bit. I think I mentioned to you before that the ratings agent, Russell, for example, I think is applying this and inviting the chance to sort of, with their larger clients, to sort of dial up or dial down, the ESG quotient as they're defining it, and trying to mark out what would be the quote unquote the cost of that holding at some threshold score across a full cycle. So, if you assume that there's merit to that approach, then there will be a way of quote unquote measuring it. But Scott brings up, and others evoke the same issue, which is that there's a lot of disagreement about the mechanism or framework or the blueprint, if you will, for establishing the ESG quotient. It is an understatement. It's a profound understatement. So I think I've seen white papers that have said, ESG scores have sort of, outperformed, but that also mirrors a consumer and tech tilt to this sort of equity-based strategy. Because a lot of those, sort of software as a service and other firms were sort of better set up to be able to, how should I say, obtain or claim these higher things. Obviously, industrial companies would not be. In this part of the cycle, that obviously looks to have been very favorable, time will tell, and meanwhile, the criterion framework is being fiercely debated as it relates to what should stand as the sort of benchmark in these areas, or even establish criteria for each of those segments. So I would tell you what's happening from a research perspective is that we're using research to determine and assess and describe the framework. There are some who simply omit certain areas from what I would call a traditional sort of stock picking or active management approach. Others are doing that, as well as advocating companies and trying to force companies that they invest with, using their capital weight to influence decision making. There's enormous, it's heterogeneous quality to it. There are a number of people who position themselves as ESG consultants that I would argue are not really investment managers, but they're cheerleaders and advocates for a perspective and a worldview, which may be admirable, but that's different from providing financial advice or what I would call fiduciary type services. There's a whole bunch of controversy about how pensions can be managed and whether they can use non-financial criteria to target goals. And that may not sound like, boy, but I would tell you that with retirement money being pegged to this, this is incredibly important stuff as it relates to what could create, criminal liability, if you will. So we're in early days, but it's a fascinating space, and I'm
Great.
sure my colleagues
I think we have to keep rolling. We just have one last question, and I have one last question. I think we'll wrap this up.
Say on this side, I'm not sure that it is really very difficult to decide what the criteria should be, but I think we just don't know what the final measures are going to be. But I think the measurements are going to be financial results. And Mark Carney, the recently retired governor of Bank of England, in particular, has made great points about impairment of capital. And it's ironic that this is happening at a time when so many people have moved towards acceptance of passively managed funds. We are now seeing perhaps the need for some analysts. So perhaps some people may get their jobs back if they have the right skills.
I heard you.
So go ahead with your
So, I mean,
question.
I don't want to give a lecture, but the effect of all of this may have something to do with profit margins.
I think if people are consistently willing to assign a higher multiple to companies that have high ESG scores but lower margins, perhaps, or lower cash flows, that's really going to be a driver here.
I don't think you can talk about higher ESG scores and lower margins. I mean, higher ESG scores may or may not translate. I mean, analysts are really going to have to estimate what's going to happen in the future.
Of course.
And so much of what's feeding models is what has happened in the past.
Yeah.
I'll leave my comments there then.
Yeah. Okay. We can. I think ESG is a hot topic. We can continue that after the panel.
Oh, good.
I would argue there's not debate that there are very significant non-financial drivers of value that people are already assigning value to fundamentally. Yeah, I don't. The question is how well they're doing it. But I mean, I think there's no doubt that that's happening. And I think some of the work, whether the company's Unilever or whether it's Starbucks or others, there's no doubt that some of the decisions they've made years ago, which are not that seem sort of counterproductive, are in fact a very valuable part of a trend towards efficiency, environmental sensibility, which actually has proven to make economic sense, but perhaps not initially. But it takes some imagination to be able to see that, and it takes imagination for people to be able to conceptualize that a management team that is executing in that way is actually a superior company. And I think this isn't just speculative, this is happening. So the question is how much more financial capital is going to get behind similar assessments.
I wasn't going to go there, but I will now, right? So I think I think a lot of companies.
Quickly, sir. Quickly.
I think a lot of innovation. I know, Charlie. Sorry. I think a lot of innovation will be. If people want to leave, they can go. A lot of innovation will be driven by these companies and by the capital markets. And if people allocate money to the companies that are making progress, that's going to change the calculus in society. I think, I don't know about you, but I don't have a lot of confidence in a bifurcated political system, representative political system, where one side wants to pretend that there's nothing wrong and we can all go about our lives, and the other side wants to take away your car and your hot shower, right? Neither of those is the answer. It's somewhere in the middle, and I think that'll be driven by capital markets and capital flows that are responding to people's attention to those issues. Pardon me? Well, we love having you here. Thank you.
All right. So let's end with this. I think everyone's going to go home, I'm confident in saying this, and express to their significant other or their dog or their cat about the one key takeaway they took from this conversation. I'm confident in saying that. So I want to go down the line. Let's end with this. Let's circle back. What's the one, or maybe two, but briefly, key takeaways each of you wants the audience to tell their significant other or pet when they get home?
My wife doesn't want to hear anything about this.
If she did.
Yeah, we didn't really talk about this, but as I thought about this question beforehand, I thought, at the end of the day, I would like everyone to take away the fact that alternative investments are appropriate for every client's portfolio. The question is how you use them. Right, we didn't talk a lot about the institutional model and their usage of these versus the retail model and their usage of these, and how much more difficult it is to have that retail investor truly understand what they're investing in and why they're investing in it, and to be properly educated. So there's a big challenge ahead for both sponsors and financial advisors to explain to clients exactly why they are putting what they're putting into their portfolio. But at some level, it does belong in all portfolios.
Yeah, and on the top of that, maybe, I guess I'll say two things, because I didn't have much to say about the ESG topic. Two things. So one is, on the heels of what was just said, I think, the why are you allocating is a really important point with alternatives. These are clearly more abstract, in some cases more complex, so that why is something that I really would encourage you to think about, in particular if you're having discussions with individual investors. I always think of my 77-year-old mom who's on a fixed income. How do I explain some of the strategies I sell and support? I'm always thinking about that why. And then the last thing is, I'm sure there are skeptics in the audience with regards to alternatives. Alternatives doesn't necessarily have a great connotation with a lot of people, but I hope it's evident from today's panel that there has been a lot of evolution and improvement in the space. Fees is an obvious thing. We continue to see downward pressure on fees, but also quality of product construction is markedly better today than it was in the past, and that will continue. So if I had to pick one thing of those two, it would be re-underwriting of the space, because I think there is a ton of great product out there, and I would argue people are going to need it more than ever right now, given the outlook for traditional investments.
So what I would sum up with is that I think, again, why? Right? It's about diversification. Right? It's about embedding your portfolio's risk-return characteristics. But it's not easy. So it's about why, and it's about remembering why. Right? Because you're going to have periods like we've seen recently where you've diversified away from something that's done very well. And that's going to happen with some regularity. And it's about remembering why you're doing this and understanding the strategies well enough to have the confidence to stick with them when it seems like they're not working, or they're not working relative to something that it's uncorrelated to. And so you need to think about return sources, you need to diversify those return sources, and really importantly, you have to think about what is the intuition for returns. How confident am I that this is going to produce a attractive return and an uncorrelated source of return, and then keep reminding yourself of that.
Alternatives are a talent pool, not an asset class. I think that is a critical element, and I think a lot of the confusion around labels and exposures creates distortions. I would say simply that intelligently researched and thoughtfully allocated, they can be a valuable source of diversification in a portfolio, but research is critical, and a material commitment to research, I think, is absolutely essential to succeeding with the use of alternatives to diversify portfolios.
Great. Well, thank you to the panelists. Thank you to all of you for sticking around and listening. I really hope you enjoyed this conversation. I do want to quickly plug an event that's in the works right now for early May, that's also going to be focused on alternatives and more specifically real assets. So we are hoping to have a panel that represents real estate, timber, and infrastructure. So if you enjoy this topic, hopefully you'll like that event. It's not finalized yet, but it should come out, and it'll be, I think, in early May. So thank you again, and appreciate everyone's time.